Hello everyone, welcome to this session on KYC training. In this session, we will discuss what KYC is in banking. As we move through the slides, we will understand each concept step by step. Nowadays, we frequently hear the term called KYC. But what exactly does KYC mean? And why do financial institutions ask their clients to provide personal information before opening an account or onboarding them? So let's take a closer look at the definition, what KYC is. So it says know your customer is a process by banks and companies to verify a customer's identity. It involves collecting documents like the driving license, passport, PAN, Aadhaar card or other ID proofs depends on the countries. The purpose of KYC is to ensure that the customer is genuine and not involved in any illegal activities. So by obtaining this KYC, it helps prevent fraud, money laundering, and misuse of financial services. So it means when the bank is going to onboard a client, so they request to provide KYC documents. So basis on that, they will get to know who their customers are. So we'll look into more detail what happens at the time of onboarding. Now, we'll breaking down the acronym what KYC is. Know your customer. So the word itself it says know your customer. It means the financial institutions has to know who their customers are. So in the previous slide, we have gone through the definition of what KYC is, and we have seen some of the words kind identifying the customer and verifying the customer, the illegal activities, money laundering. So we'll go through the each and every aspect from the KYC perspective. We will now understand who a customer is. A customer is an individual or an entity that maintains a business relationship with your company. However, in the context of banking, the term customer is often used even prior to the establishment of formal business relationship. So typically before an account is opened or a client is formally onboarded, the individual or entity may be referred to as a prospective customer, an applicant, client or customer to be. But banks use customer in a broader sense because the process is meant to be decide whether to accept them as a customer. So even if we see like the regulatory frameworks like in India, Reserve Bank of India and other foreign countries, according to their regulators, we can see the terminology called KYC, know your customer. That is a standard terminology where we can see across the world. So it simplifies the communication instead of saying prospective customer, applicant, okay, and customer to be. Now we'll come to the point identifying the customer. So what a customer identification is. So basically it is the process of collecting details about a person or entity. So when I'm referring entity, it means it is a company who wants to use banking services. So what kind of information it includes in the identification of customer? So the documents must and should contain your details. For an example, if a person is going to open a bank account, that person has to provide some identifying documents. It contains their names, date of birth, address. So everything related to them, like the personal details will be there. Okay, and it will be same to the companies as well. The company registration certificates, okay, and other documents related to a company. So what happens here? So basis on this documentation like the identity documents, the bank will get to know who you are. It doesn't mean like you are entering into a financial institution and you requested to open a bank account. So the account will not get opened until you provide the documents to the staff of that financial institution. They want to know who you are. So by saying by word of mouth, or like we are saying directly, so I am so and so, please open a bank account to us. It doesn't mean. So they want to know how they will get to know who you are. So basis on the documents you have, your identification documents. So you will provide it to the employees of that financial institution to initiate the client onboarding process. So by taking all these documents, this helps the bank to confirm who the person is or an entity is who are going to open a bank account. And it is the first stage of KYC before verifying the details. To put simply, what identification means? It means who are you? It means the financial institutions will get to know who are you basis on the identification documents you provided. What is verification? So we discussed about what is identification of documents, or like the customer identification. Sorry. What is verification? So we discussed in the previous slide what is the identification of customer. So it is not fully completed by taking the documents of the customers. So after getting the documents of the customers, the bank has to verify those documents. It means, is the information is correct? Is the information of the clients are correct basis on the identification documents they have provided? So how the verification will be conducted? So what a verification is? So verification of customer is the process of checking whether the details provided by a person or an entity are true and valid. So it involves the verifying of provided documents. The bank or the financial institutions confirms the authenticity of the information using the valid sources. So what are the valid sources? So let's take an example, an individual and an entity. So for individual, so the financial institutions may have some tools where they can check the documents, they can verify the documents. There may be several criterias internally. And coming to the point of an entity, so let's take, there is a company called A that is registered in UK. So to verify the information of that particular company, so we can go through the UK's company's house, wherein you can check the details of an entity. It means not all the types of entities, like we'll discuss in upcoming sessions. What are the different types of entities, like private limited, public limited, okay, trusts, partnerships. So different types of entities, we call these as legal forms. Okay, what I mentioned. So we'll discuss in the upcoming sessions. Okay, from these valid sources, the banks verify the information of their clients. So sometimes what will happen, if you take any company name and you search in Google, you will find a number of pages. It means a number of links you can see. So all the websites, maybe for example, all the websites are providing the information related to that particular company. It doesn't mean like we can take information from all those websites. Okay, so there will be some valid sources and valid websites where the banks can consider the information. Only from those particular websites only the verification can be happened. It means the verification of the client information can be happened. So in simply we can say, we have discussed like identification means who are you. It means it is referring to the clients. So in verification, it is proving that the information given by the clients are correct. So this is what verification is, verifying the customer identity. So this is called verification of customer identity. So, what is an illegal activity? What are illegal activities? So, illegal activities are actions that are against the law. They are not allowed by the government and it can lead to punishment. So illegal activities. So when we are discussing about the definition of know your customer, we have seen multiple words, right? We are going through what exactly those words are, like the identification of customer, verifying the customer information, okay, and following those like illegal activities. Okay, so the illegal activities can be fraud, money laundering, theft, or identity misuse. So we'll go through what exactly these are. What is money laundering? So money laundering is the process of making illegally earned money look legal. So it involves hiding the real source of money obtained from the criminal proceedings or crimes. The money is passed through banks or business to appear genuine. This is done to use the money without raising suspicion. So we look into more detail like what money laundering is. Okay, so we might have heard about the word called laundry services maybe, okay, wherein or like we use the washing machine to make our dirt clothes clean. Okay, so that is the case like the laundering. What came here, money laundering, it means the money which people earned from the illegal activities, drug trafficking, human trafficking, okay, corruption. So whatever which are fall under the activities of illegal things, the money earned from those activities are called black money or dirt money. Now the fraudsters are trying to make that dirt money as clean money. So in this process, like in money laundering, they'll try to hide the source. It means from where they have received that funds. Okay, that hide will be source, and they'll try to make that black money as white. It means they'll try to convert that black money to look as a legal. So this is called what money laundering at basic. There are three stages of money laundering: the placement, layering, and integration. So what happens at the stage of placement? So illegal money is introduced into the financial system. They'll infuse the money into the financial system from the direct association of crime. So and then what next is, the next stage is layering. So in this stage, the money is moved through complex of transactions to obscure its origin. It means here they'll try to create multiple layers. It means the money will be transferred to multiple accounts, and it is very difficult for the financial institutions to trace out. And integration, it is the final stage where the money which is infused in the financial system, the laundered money re-enters the economy, appears to be legitimate. It means at this point of stage, the black money has converted as a legal money or white money or valid money. So we'll discuss in more detail what placement is, layering is, and what is integration with some examples. Before entering into the further explanation related to three stages of money laundering called placement, layering, and integration, so we'll try to understand why the KYC is matters. So why the KYC is matters and why the KYC is important. The KYC is a critical safeguard for the financial system, and it helps preventing frauds, stops money laundering, prevent misuse of financial services. So we discussed like identification and verification of the customer's identity, and we discussed about what money laundering is. So let us consider there is a person who is going to open a bank account and that person has submitted the KYC records. It means like their identity information has been submitted to the bank. When the bank verifying the information, they have identified that the provided documents are not valid. The provided documents are not valid. So it means the initial intention, taking an example, maybe that person initial intention is to create, to do fraud by utilizing the financial institutions. It means that person is trying to abuse the financial system. Okay, so if the bank misses to verify the information properly, what happens later? That person can do the money laundering using the bank account. So if the verification is done properly, okay, so after the identification and verification, there are several steps as well, like screening, wherein the banks identify some kind of hits any like negative media, sanctions relevant information, okay, PEPs. So a number of aspects are there, okay, and so many risk related information can be assessed by the financial institutions basis on the customer profile. Okay, not it doesn't mean not only there the banks or like the financial institutions are verifying the only the identity documents provided by the clients. Okay, so by taking the required documents from the clients and verifying that information and having all the required information of the client, so now the bank is able to assess the risk from the particular customers. So if they fail to meet the expectation of KYC or AML, anti-money laundering, we'll discuss about that what anti-money laundering is. So there be a chance for the fraudsters to conduct this money laundering by utilizing the financial systems. Okay, so that is the reason why the KYC matters, in order to avoid such kind of risks raised by the people using the financial system who or want to abuse the financial system. The banks or the financial institutions are taking the KYC information of clients. So in a simple way to understand, like what is KYC, know your customer, till now what we have discussed. So it is the identification and verification of the customer identity and assessing the risk assessment and a few other aspects as well. And after following all the requirements, meeting all the requirements from the client, the bank now will decide whether the client can be onboarded or not. It means accept or reject in the sense. So basis on the information the clients provided and the bank's risk assessment outcome, so they will finalize whether to open a bank account or not. It means like accept or reject. Okay, KYC, it means know your customer, ensures that banks and companies can confirm a customer is genuine and they are not involved in any illegal activities, and that financial services are protected from fraud, money laundering and misuse. Thank you for watching this presentation. If you find this video informative, please like, share and subscribe to the channel for more such content. Thank you for watching this presentation. If you find this video informative, please like, share and subscribe to the channel for more such content.